Have you ever, like, looked at a company's financials and just wondered, okay, how exactly did they get to that revenue number?
Mm.
It seems simple, right? Sell something, get money, record it. But, like a lot of things in business, there's always more going on underneath, some really interesting layers. So today we're doing a deep dive into step 3 of revenue recognition. That's determining the transaction price. We're going to try and untangle how companies figure out the actual amount of revenue to put on the books, especially when the price isn't just, a fixed sticker price. Sometimes it is straightforward. You buy a car, there's the price. Simple. But lots of deals have, well, complexities, things that can really change that final number. Hopefully this deep dive gives you some practical insights, maybe a few aha moments about this crucial accounting step. But before we really jump in, just a quick reminder. This deep dive is based on material from Farhat lectures. All the content, examples, explanations, everything we talk about today comes from the resources over at farhatlectures.com.
So whether you're an accounting student prepping for the CPA exam or you're already a professional, definitely check out the website. They've got more practice questions, video lectures, tons of support to really nail down what we cover today. Huge thanks to Professor Farhat for providing all this great material. Okay, so let's unpack this. Transaction price. Fundamentally, it's what a company expects to get from a customer, right? When is it easy? And maybe more importantly for us today, when does it start to get tricky?
Yeah, that's the key question. And what's interesting is, sure, fixed prices are common. We see them everywhere. But the accounting rules, they're smart. They recognize prices aren't always carved in stone. Lots of contracts have conditions, or what we call variable considerations. These can seriously affect the final price paid, which brings up a really important point. How do you even account for revenue if you don't know the exact final price yet? Requires some foresight.
Foresight, definitely. So, okay, beyond just a simple fixed price, what are these variable considerations or conditions that can shake things up?
Well, we can generally group these complexities into 4 main buckets that impact how we nail down that transaction price. First, there's variable consideration itself. That's where prices depend on future stuff happening. Second, time value of money comes into play when payments are, stretched out over time. Third is non-cash consideration, getting paid in something other than, well, cash. And finally, number 4 is consideration paid or payable to the customer, things like rebates and discounts.
Okay, let's start with that first one, variable consideration. Because, yeah, that sounds really interesting. You're saying the price actually hinges on something happening or not happening in the future. Can you give us an example?
Oh, absolutely. A classic one is a performance bonus. Think about a construction project maybe, or software development. There might be a bonus tied to hitting certain deadlines or quality metrics. You don't actually know for sure if you'll earn that bonus until the future event happens. But here's the critical part. Companies are often allowed to estimate this variable amount. They can include an estimate in their revenue now, even with that uncertainty hanging there.
Estimating something uncertain. Sounds a bit like using a crystal ball, doesn't it? How do they actually do that? What are the, accepted methods? Is it just a guess or more calculated?
It's definitely meant to be more calculated than a guess, especially if they have good data. There are 2 main methods the rules lay out, the expected value method and the most likely method. So the expected value method. Think of it as a probability-weighted average. You look at a range of possible outcomes, assign probabilities to each one, and calculate the weighted average amount. This method works best when a company has significant past experience, lots of similar contracts. They have reliable data to base those probabilities on, and of course the probabilities have to add up to 100%.
Okay, statistical approach.
Exactly. Then there's a most likely method. This one's simpler. You just pick the single most probable amount from the range of possible outcomes. It's really best suited for situations with, binary outcomes.
Binary.
Only 2 possible results. You either get the full bonus or you get nothing, that kind of thing. You just pick the outcome that has the higher probability, the one that's more likely than not.
Okay, that helps. Can we walk through maybe a quick scenario? Seeing them in action might make the difference clearer.
Sure, yeah. Let's use the Maze website example from Farhat lectures. Maze agrees to build a website for a client for $20,000, standard fee. But there's a potential $2,000 performance bonus if they complete it on time. Here's the twist, though. That bonus decreases by 10% for every 10 days they're late. And Maze, importantly, has done tons of these projects before. They have good historical data.
Okay, so they have experience. How would they apply the methods?
Right. So using the expected value method, Maze looks at their history and estimates probabilities. Maybe they figure a 60% chance they finish on time, get the full $2,000 bonus. Total price, $22,000. Then maybe a 30% chance they're 10 days late. That means a 10% bonus cut. So an $1,800 bonus total price, $21,800.
Yeah.
And say a 10% chance they're 20 days late. 20% bonus cut. So $1,600 bonus total price, $21,600.
Got it. Different scenarios, different probabilities.
Exactly. Then they do the math. $22,060 plus $21,800.30. That comes out to $21,900. That's their probability-weighted transaction price. And that's the revenue they'd recognize upfront based on that expected value.
Okay, that makes sense. What about the other method, the most likely?
Well, let's tweak the scenario slightly. What if the bonus was purely binary? Maze either gets the full $2,000 if on time, or they get nothing if they're late. And let's say they still estimate that 60% chance of being on time.
Okay, so only two outcomes now.
Right. In this case, they'd use the most likely method. Since 60% getting the bonus is more likely than 40% getting nothing, they'd go with the outcome associated with the 60%. So they'd recognize the transaction price as $22,000, the $20,000 base, plus the full $2,000 bonus they expect to get.
Ah, okay. So it depends on the nature of the variable part and the company's experience. It's not just a random guess. It's grounded in data, ideally. But what if they don't have that solid past experience? Or what if things are just too uncertain? Can a company just not include the variable part? Is there some kind of limit or constraint?
Yes, absolutely. And it's a really important constraint. It's there to prevent companies from booking revenue that might just disappear later. If a company lacks that sufficient experience, or if they just can't reliably estimate the amount without a high chance of having to reverse it later, then recognizing that variable part of the revenue is constrained.
Constrained, meaning?
Meaning they have to wait. They basically can't recognize that uncertain variable portion of the revenue until the uncertainty is resolved. So in our Maze example, if they were totally new to web design and had no idea about timelines, they might only recognize the fixed $20,000 upfront. They'd have to wait until the project's done and they know the actual bonus amount before recognizing that extra bit.
That makes sense. It prevents overstating revenue based on shaky estimates, like don't count your chickens before they hatch, especially if the eggs might not even be real.
Exactly. It protects the integrity of the financial statements. Imagine booking a huge bonus you think you'll get, telling investors, and then having to take it all back. Not good.
Right. Erodes trust. Okay, so that covers prices changing based on future events. But what if the price itself is fixed, but the payment is delayed, like way down the road? Does simple time passing affect the revenue number?
It certainly does. That brings us to our second category, the time value of money. If there's what we call a significant financing component in the contract, meaning the customer pays much later than when the service or good is delivered, you essentially have to split the transaction in your accounting.
Split it? How so?
You split it into two parts. There's the delivery component. That's the actual value of the goods or services provided today. And that's measured by the present value of those future payments, what that future cash is worth right now. Then there's the financing component. That's basically the interest the company earns because they're effectively lending money to the customer by letting them pay later. And that interest income is recognized separately over the life of the financing period.
Whoa, okay, so you can't just record the full, say, $1 million you'll get in 3 years as revenue today?
Nope, absolutely not, if there's a significant financing piece.
That seems like something people might miss. Can you give us an example?
Sure. Let's use the Adam Company and Ryan Company consulting example. Adam Co. provides consulting services to Ryan Co. The fair value, the real worth of those services today, is $800,000. But instead of paying cash now, Ryan gives Adam a zero-interest note promising to pay $1,000 in 3 years.
Okay, $800 worth of work, $1 payment later.
Right. So when Adam Co. does the accounting, they record sales revenue of only $800,000. That's the value of the service they delivered. They'll record a notes receivable for the full $1 million they expect to collect. But the difference, that $200,000, that's not service revenue.
What is it then?
It's initially recorded as a discount on notes receivable. It represents the future interest income Adam will earn over those 3 years. They'll gradually recognize that $200,000 as interest revenue over the 3-year period, usually using something called the effective interest method, maybe at a rate like, say, 7.72% in this example.
So part of that $1 million they eventually collect is for the consulting, and part is basically interest for waiting.
Precisely. The time value of money forces you to separate the value of the actual performance from the value of the financing arrangement.
Got it. So for you listening, the key takeaway: a big delay in payment means you can't just book the face value of the future payment as revenue now, part of its interest income recognized over time. Does this complexity maybe push companies to ask for cash up front more often?
It could, yeah. It's a strategic consideration. Do you want the complexity and the delayed recognition of the full amount? Or do you push for quicker payment? Depends on the business and the customer relationship.
Right. Okay, so time matters. What about when payment isn't delayed, but it's not even cash? How do you determine the transaction price if you get paid in like equipment or land or maybe even services from the customer?
Good question. That's our third category, non-cash consideration. It's actually pretty straightforward conceptually. If you provide your service and the customer pays you with something other than cash equipment, land, stocks, even their own services, the transaction price is simply the fair value of whatever you received.
Fair value. So market value.
Essentially, yes. What's that non-cash item worth in the open market on the date you receive it? That becomes your revenue. Sometimes that means getting an appraisal, for something unique like land. Other times, like for stock, it's easier to find the market price.
Okay, so value what you get. Makes sense. Now for the last one, which sounded kind of backwards, consideration paid or payable to the customer. Why on earth would a company pay its own customer or give them credits back?
Huh. Yeah, it does sound counterintuitive at first glance, doesn't it? But think about common business practices. This covers things like incentives, stuff designed to encourage customers to buy more, or maybe pay their bills faster.
Ah, okay,
Like sales discounts, volume rebates, buy more, get a percentage back, coupons for future purchases, even free products sometimes bundled with the sale.
right, okay. I remember those mail-in rebates for computers back in the day, that kind of thing.
Exactly like that. Perfect example.
So how does giving something back to the customer affect the revenue the company records?
It directly reduces the transaction price, and therefore it reduces the net sales revenue recognized.
Okay, so it lowers the top line.
Yep. So using your rebate example, you buy a computer for $1,000. The company initially records maybe $1,000 in sales, but then you send in the form and get a $100 rebate check. That $100 effectively reduces the company's net revenue from that sale down to $900.
So they have to account for that potential reduction.
Yeah,
Maybe even estimate how many people will actually claim the rebate.
precisely. They often estimate that redemption rate based on past experience. Let's look at the Adam Company volume discount example. Adam Co. tells its customer, Ryan Co., hey, if you buy at least $1 million worth of stuff from us this year, we'll give you a 2% discount on everything.
Okay, a volume incentive.
Right. So in the first quarter, Adam sells $550,000 worth of goods to Ryan. Now, Adam looks at their history with Ryan. They know Ryan almost always buys way more than $1 million a year. They fully expect Ryan to hit that threshold.
So they anticipate the discount will happen.
Exactly. Because they anticipate it, Adam doesn't record the full $550,000 as revenue. They proactively reduce it by the expected 2% discount, $11,000. So they'd record accounts receivable and sales revenue for the net amount, $539,000. They recognize the reduced revenue right away.
And what if, say, Ryan has a bad year and doesn't hit the $1 million mark?
Good question. If at year end Ryan hasn't met the threshold, they don't get the discount. Adam would then adjust their books. They'd basically recognize that extra $11,000 in revenue at that point, reflecting that Ryan forfeited the discount. It often goes into an account like sales discounts forfeited, which is like other revenue.
Wow, okay. This deep dive really shows how much can go into that single revenue number, determining the transaction price. It's definitely not just looking at a price tag. You've got estimating future events, dealing with the time value of money, valuing non-cash stuff, even accounting for money, going back to the customer.
Yeah.
It's quite a process.
It really is. And if you connect it to the bigger picture, getting this transaction price right is absolutely fundamental. It directly drives the revenue number on the income statement. And that number influences everything: investor perceptions, stock prices, loan covenants, internal budgeting, everything. It just underscores the critical thinking involved in accounting. You're not just plugging numbers. You're analyzing contracts, assessing probabilities, understanding the economics of the deal.
So the practical takeaway for you listening: next time you see a company's revenue, just remember the complexity behind it. It's not just a raw sales count. It's a carefully calculated figure shaped by estimates, timing, incentives, and the specific terms of their deals. It really tells a story.
And maybe it prompts a question for you to think about. How do a company's strategic choices, like offering those big volume discounts or generous payment terms, how do those decisions directly weave into their accounting and potentially shape how investors see their performance? It highlights that deep link between business strategy and the accounting rules.
Absolutely. And look, if you want to really dig deeper into these concepts, get more examples, test yourself, we strongly recommend checking out farhatlectures.com. Professor Farhat has comprehensive resources, videos, multiple choice questions, detailed explanations that cover everything we discussed today and much more. It's a fantastic way to reinforce your understanding and get ready for exams or just boost your professional knowledge. Seriously, don't shortchange yourself. Investing in your accounting education is always worth it. Well, that wraps up another deep dive. Thanks so much for tuning in. We look forward to exploring another fascinating accounting topic with you again.